Hi, today we are going to be talking about the accounting equation. We're going to be introducing a couple of the types of businesses and types of ownerships of companies. And so we're going to talk about different pieces of the accounting equation, and we're going to fill in how the positives and negatives affect. So let's first look at this, and we're going to be working with Michael Delgado for his personal website business, and he builds websites for other people. This business that performs an act for a fee is called a service business. And so on your types of business, in that first circle, write service, and does something, performs a service for a fee is a descriptor. So off to the left, you'll put does something for a fee. Oh, and up at the top, business entity, an institution that is in existence to serve a purpose. So in types of business, you should have three things filled in. The first bubble is service, and the arrow it points to says does something for or performs a service for a fee. And business entity is an institution that is in existence to serve for a purpose. And so the other thing is this is, and this is what we're going to be working with for the first, I believe it's 9 chapters. And that is we are going to be working with a service business, and the type of business is a proprietorship. That is a business is owned by one person. And so on the types of ownership, put proprietorship, or if you want to put sole, SOLE, proprietorship, is a business that is owned by one person. A business plan is how he sets up his business, and it's going to go over some of his different details here. GAAP is the generally accepted accounting principles, and this usually said as GAAP. One of the concept measures is a unit of measure, and so if you look over on your GAAP, you're going to find unit of measure. And I believe I put that on our third tab, and go ahead and write in the definition. It is a business transactions that are reported in numbers that have a common values that are used in common units of measure. And we'll be going through different ones as we go through this. And again, here's information about the business entity. So the accounting equation, this is up at the top of the middle section. Assets equal liabilities plus owner's equity. So assets are things that you own. So under the T charts, which are right underneath it, you'll see a star, and right beside the star, I put anything owned. Those are things you own. They are things that have value. They're like your equity, things that you have equities. So he may have a computer. That's something he would own. That's an asset. Liabilities are things that you owe. So under the liabilities tab, I put anything owed. And the last thing, so your liability is what you owe, plus your owner's equity is going to equal your assets. Owner's equity is what he has. It may include things like his investments. It will have where we add in what we sold. If we're going to take out our expenses, and we're going to take out what we get for paychecks. So those are all going to affect the owner's equity. And so owner's equity is going to deal with the money coming in and out, as in we're going to receive money in for services. We're going to give money out by expenses. We're going to pay ourselves, that's something that's going to go out. So owner's equity and assets are going to have more of those type. Liabilities is going to be really limited. It's going to be it's going to have something that we owe somebody. So if it's something that we owe somebody else, it's a liability. So if you look on your T-charts, and those little cheese are on your graphs, you'll see that cash, petty cash, supplies, accounts receivable, that's what someone owes us, equipment, prepaid insurance is all assets. I want you to put a plus sign on the right-hand side of all of those T's. Liabilities are things that we owe somebody else. And I want you to put a plus sign on the assets, put it on the left-hand side, and on the liabilities, put it on the right-hand side. Owner's equity. Just so you can see how this looks. Assets, you're going to be increasing on the cash on the left-hand side, decreasing on the right-hand side. And the same thing for all your assets. Liabilities, decreasing on the left-hand side, increasing on the right side. Anything owed. And now owner's equity, there's two different sides. If it's something that's coming in, like an investment or you sold services, then we are going to increase on the right-hand side and decrease on the other. If you're taking money out, drawing account is like your withdrawals. You're taking money out for personal use. That's your drawing account. So you may be paying yourself your paycheck. That's the drawing account. Expenses are also going to be coming out of here. Your rent, your advertisement, the gas money you use to get to locations, shipping, utilities, other things that there's a lot of expenses categories that we will create. The bigger the business, the more expense categories we seem to create. So let's go back to the assignment. And so we're going to be looking at how these different things affect owner's equity. And so if you'll read through the book, I'm not going to read through this with you, but it's going to show you what it started off with and then what did we increase. So if we begin with cash, we're going to add to both the capital and the cash. That's if you receive an investment from the owner. Pay cash for supplies. We're going to decrease cash, but our supplies are going to increase. The same thing's going to happen if we pay for insurance. We're decreasing our cash amount. That's like our bank account. Cash is bank account. But we're increasing how much we have in our insurance account. And then if we have something on account, that means someone paid us or we bought something where we owe somebody. Excuse me, I forgot which one we're doing. Accounts payable, we owe someone else. We need to pay somebody. That's a liability. And so if we create an account, it's going to increase both sides. It's going to decrease both sides if we make a payment to them. And so on this equation, we have to keep it balanced. Think about if we were in algebra. What we need to do is that equal sign. We can't change the balance to where they're no longer equal. So if we add to one side, we have to add to the other. Or we can add and subtract from the same side as long as they're the same amounts. So every transaction is going to have two things that happen. We have the account it started from and the account it's going to. So let's go and look at the work together and see what's going on with these. And today we are just going to be telling, is it going to increase or decrease? We're not worried about dollar amount. So we bought supplies on account. So that's going to increase how much we owe, but it's also going to increase our supplies. So assets and liabilities both increase. Received cash from owner as an investment anytime we deal with the owner on that, it's either going to increase or decrease owner's equity. We received cash as an investment, so that's going to increase. He's increased the amount of capital in the company, but we're also going to increase the assets because our cash in our bank account went up. Paid cash for insurance. So we're going to decrease our cash account, but we're also going to increase how much we have in insurance. So we have a decrease and an increase. So you have a minus and a plus, both in the assets column. And then we pay cash on account. So we're going to pay off some of our debt. So our cash is going to go down, but so is how much we owe somebody. So both of those are going to be subtraction. Now do your on your own by yourself.